Thank you for joining us. I'm Gord Long. As always, it's my pleasure to have back with me today Charles Hugh Smith, well-followed and prolific writer on the web, who is the publisher of the website of2minds.com. Welcome back, Charles. It's great to get caught up again.
Yes, thank you very much, Gordon. It's my pleasure to join you on a terrific topic today.
Charles, before we begin, as I normally do, I need to stress with our new viewers that this is not an interview. We do these videos as a way of us productively dialoguing the important trends we're identifying and simply make our discussions available to the public for those that might be interested or want to contribute comments, which we very much welcome and read them all. Today our talk will follow on from our last session, which was entitled The Coming Deflationary Tsunami, and we'll discuss how COVID has triggered what we believe is the next great financial crisis. It's now baked in, which will subsequently be an even bigger event than the deflationary tsunami. As such, we hope to cover the subject areas that we have listed here. Any comments before we begin, Charles?
No, I'll wait for you to go ahead and cover the agenda and the basic framework of our discussion today.
So let's jump right in on today's discussion. We're going to move through the charts quickly for the sake of time, but leave you to study them at your leisure if you so want. As I said, this session is a follow-on to our last video entitled The Coming Deflationary Tsunami. COVID has triggered the next financial crisis. The deflationary tsunami is only going to be a precursor to the main attraction, which we'll experience before this decade is out. Though it is not imminent, it is now inevitable and frankly unavoidable. It's long overdue, but very importantly, it's healthy for the future. It needs to happen. We will be better off on the other side of this event. So let me first set the stage for the problem ahead so we understand what will trigger and why it's going to trigger it. And that is, after World War II, the U.S. economy was unquestionably the strongest in the world and led the crippled developed economies out of the darkness of shattered economies. And the emerging U.S. baby boomer economy rode a wave of unprecedented prosperity as the U.S. economy exploded as the industrial giant of the globe. And the expansion of a U.S. middle class launched consumption in the U.S., which made the U.S. not only the industrial power in the world, but the prime consumer of goods and services of this new global economy. And over the last 7 decades, U.S. consumption, as shown here, has reached almost 70% of the U.S. economy. No other global economy is even close to that. Maybe 55%, but most are down to 35%. And for example, the retail space, Charles, we did shows on this and the malls and everything else 3-4 years ago. Retail space is an order of magnitude larger than other developed economies and the envy of emerging economies around the world. And by the 1990s, I can recall business analysts were then all questioning how long can the U.S. consumer keep consuming at such a rate? But instead, it's only got even larger as consumer credit then exploded, with foreigners, frankly, strategically buying U.S. treasuries with their growing currency reserves, thereby keeping credit readily available to the U.S. consumer and at ever cheaper rates for an ever-consuming and increasing U.S. middle class. Any comments on that so far, Charles?
Yeah, I think you've described this, the feedback that's kept consumption rising in the U.S. very, very well, which is that we're running enormous trade deficits, and we've been running them for decades. And of course, that started back in the late 60s, early 70s, and it's just gathered momentum for the last 50 years. And that's one of the contexts that we're talking about here is overconsumption. In other words, we're consuming more than we produce, and this is why we buy trillions of dollars of goods and services more than we export, right? And that overconsumption has consequences. And so the way I would describe our topic today is that COVID is a catalyst that is acting on distortions and fragilities that predate the pandemic, right? We're talking about uh, economic issues here that have been building up, piling up for 5 decades. And so the COVID is not the cause so much, it's simply, as you say, the trigger or the catalyst to these heavily distorted fragilities. And so that's how I would describe the agenda today.
Precisely. It's not COVID, it's our reaction to COVID, as we'll see here in a couple moments on these charts. Charles, in the 1990s, going through this sequence of events, the U.S. began, frankly, a massive deindustrialization, with companies moving offshore, and you can remember downsizing, right-sizing, offshoring, etc., to capture labor arbitrage and competitive advantages. So initially, Japan and the Asian tigers took advantage of this, initially in the 80s, then the 90s, but by early part of this millennium, China took over from them and became the global industrial giant versus what America had been. However, because of their mercantile strategies, their Asian mercantile strategies of redeploying their U.S. dollar earnings, as I said earlier, towards buying U.S. treasuries, it kept the U.S. consumption engine going and expanding further, despite us being deindustrialized and not being as competitive, and frankly starting to consume more than we were producing. However, and the strategy made foreign importers even richer. So it compounded and kept feeding on itself. The problem, however, was the foreign economies failed to foster a sufficient middle class themselves to offset this excessive U.S. consumption. And therefore, global run rates of demand are artificially way too high and inextricably tied to the U.S. consumer. That's the state we're at. And they are artificial because of an inflated valued U.S. dollar that is buying our treasuries, and a manipulated zero-bound interest rates, which our Federal Reserve and our policies are directly a function of. So the U.S., a result of this effective deindustrialization, has become, we always say, we're a service economy. Well, what's that mean? Well, frankly, it means we consume more than we produce. This is not good. We get less for more versus more for less in everything we consume. And the next generation will have it harder than the previous generation did, which is our signs that of what a failing economic system is delivering. And you can see it in the stats. We are experiencing chronic negative trade balances, negative current accounts. These are year after year. Government deficit spending as it continues to increasingly spend more than it takes in. And most importantly, credit growth replacing savings, while consumption increasingly replaces capitalism. And I've said many times, we're no longer operating as capitalism. We're really in an era of creditism, because we've replaced productive investments and the savings that result from them by credit. And a lot of these subjects, Charles, we've talked about many times before in some way as a lead up to how COVID is really going to stop this advance of consuming more than we produce. Charles, you have some key points that summarize some of the things we've talked about previously and tie into this discussion.
What I'm trying to do here is provide like a long-term historical context for what we're going through right now and what we're foreseeing happening in the next 5 to 10 years. In other words, human history runs in cycles because we're still running wetware 1.0. In other words, we still have the same human emotions of euphoria, fear of missing out, panic, fear, etc. So these cycles repeat, not exactly, but in general. And so Peter Turchin is a sociological historian who's identified three kind of key drivers of social disorder and a massive reset, in the socio-political system. One of them is the stagnation of wages due to the oversupply of labor, and we see that in the statistics of the American wage earner that adjusted for even official inflation, the purchasing power of wages has been declining for 50 years for the bottom 80% of the population. And so this means that there's less disposable income. And so we filled the gap between what we're earning and what we want to spend with credit. Hence, your discussion of creditism. And the financialization of the economy that we've described many times generates the credit, but it's imbalanced. And so the wage earner owes the money, and the owners of capital and owners of that debt generate the profits and returns on that financialization. So that's part of the puzzle here of why we're facing a different future than the last 50 years. Is you overborrow and overconsume, eventually there's consequences. The other Church and second point is overproduction of parasitic elites, which is his term for the unproductive, part of the population that lives off the profits generated by others, right? And the last one is deterioration of government finances, which, we don't need to describe, right? 30 trillion in debt, etc. Part of why, of course, the U.S. wage earners purchasing power is declining is every American worker is basically competing against the workforce of the entire global economy. And of course, there's a lot of places where wages are a lot less than paid here. And so therefore, there's been downward pressure from globalization. The other element of the overproduction of elites is it used to be that if you got an advanced degree like an MBA or a law degree or a PhD, you were basically set for life. There was going to be a well-paying, secure job for you somewhere. Well, now that's no longer the case. There's dozens of equally qualified candidates for every high-paying slot. And in terms of fiscal spending, we've, Gordon, you've laid out some slides here showing how there's just the fiscal borrowing spigot is it's overflowing, that there's going to be trillions borrowed against what? And against the national income, the national productivity. And if those aren't going to rise faster than your fiscal deficits, then you're going to dig yourself a hole you can't get out of. And this, of course, is part of what happens with these long-term cycles is, inflation rises not from two sources. One is scarcities and bottlenecks. In other words, you just simply run out of the resources that are cheap and affordable, and then you're gonna face the kind of shortages and supply chain disruptions that we're seeing now. And in the 1600s, it was shortage of lumber. You chop down all your forests, then suddenly you don't have enough wood for fuel and shipbuilding and all this other stuff. And in the modern era, there's other bottlenecks, semiconductors, shipping, et cetera, et cetera. And one last point that many historians have picked up on is at the end of these sort of cycles where growth turns to stagnation, the leadership decays, and where they were once willing to sacrifice for the common good, then they become self-absorbed and just corrupt, focusing on self-enrichment. And the general populace also loses its willingness to sacrifice and have a shared purpose. And so I think that there's a certain element of that too coming to fruition in the U.S. as we are reluctant to have to live within our means.
Charles, this chart I have here, I could put up so many charts to prove the point, and we have in previous videos, but I like this one. It refers to the LFPR, which stands for labor force participation rate, versus equity and bonds, which are in the market, in the nightly news and coming at us all the time. And you can see the dichotomy that it's just now, it's going exponentially worse in both directions. And the labor force, which is employed plus unemployed, is created by dividing it by the civilian non-institutionalized population. And a collapsing labor force participation rate in concert with exploding financial asset values does not derive productivity improvement and thereby really any economic growth. Rather, artificial economic growth is derived by credit or debt and financial leverage or risk, which is itself neither sustainable nor reflective of real economic growth. That's the situation that we're in right now. And we spelled out, I say we at MAD-SII, in 2017, a 111-page document. It was our thesis paper entitled Illusion of Growth, that detailed back then that we were living, and it's worse today, as this chart's showing, living under the false belief we have real economic growth. This is an illusion, and it's actually built on a GDP formula that is flawed for a raft of reasons that we spelled out, but minimally, it's unsuited for the economies that are based on fiat currencies and gargantuan government debt deployed as transfer payments and investment income within the GDP formula. And anybody that's studied basic mathematics, you know that many formulas and theorems are based on boundary conditions. And GDP is no different. And it was, when it was created, it was based on assumptions of that they didn't call it fiat. We have a gold-backed currency. Not trying to propose gold-backed currencies, but you just couldn't create money out of thin air. And governments didn't run deficits. They had to balance, and trade balances couldn't be done in credit. They had to be paid for by the transfer of gold. So there was a mechanism that made that GDP formula work. Well, like all government formulas, they figured out a way to use the same formula to make something else happen. And that's what they do. It's a false illusional GDP. And that's what the formula is showing here, this GDP formula. The G for government expenditure was never meant to be the dominant part of the formula, whether it's money that it prints out of nowhere in the Federal Reserve and gives as transfer payments to the left in the C for consumption. And now we got such a massive proportion of our unemployed population living off these transfer payments, or on the right as investment, which is foreigners buying the debt. And it's not on the X over here where our exports are negative and we're bringing in more imports. It doesn't work, but it sustains itself if you just continue to print money or create money fictitiously within the Federal Reserve system. But so the question is, how long does this go on? What stops it? And that's the point we're at. And I believe we're at the point now where we've actually put the pieces in place to the unintended killing of the golden goose, and the golden goose being the U.S. consumer or the U.S. consuming middle class. And there's a raft of monetary and fiscal policy initiatives that have been initiated by the new administration, and I am not being political here. I am being an economist, that will seriously impact the U.S. and consequently the global economy in coming years. This is economically a fact. Whether they're good policies because they're the right thing for our society, I'll leave others who are more informed for that to decide on that. But as an economist, this does not make sense. And they stem from over 60 executive orders. And I just randomly picked 3 here. We've reversed the U.S. as being an energy independent country. We've curtailed all oil and gas drilling licenses on federal lands in the Gulf of Mexico. We stopped the Keystone Pipeline. We have restrictions now on U.S. coal mining. Alaska and Texas and all the other states are now suing the federal government. The new Green Deal and carbon tax will further curtail this whole fossil energy independence. And we're seeing it at the gas prices now moving steadily up, and we're only at the beginnings of it. Whether we should do that or shouldn't do that, politicians and elected people can decide on that. But the fact as an investor is we will lose and are losing our energy independence. That has major financial implications for the country. Regulations, we've reduced all of the deregulations that had boomed this economy and turned them all around. That is going to be something that we have to pay for. Immigration, by opening the borders, is now going to reduce with major downward pressure on wages and benefits. And that's why unions fought for years and years and years for tighter immigration so that it would drive labor rates up or hold them up. And it's a surprise to me that the Democratic Party itself, which is the party of the unions, would have this policy. So, but I don't know. But these are things we're going to have to pay for at some point. But these are just some of the waves that are there. What's going to break this is what I'm showing here as exploding U.S. taxation. The planned explosion in U.S. taxes is unprecedented in the history of America. It covers corporate, personal income taxes, sales taxes, property taxes, license fees, tolls, and all manner of assessments at the federal, state, and local levels of government. You haven't even begun to see that are coming because the states themselves, because of all the problems fallout with COVID, and the only solution besides printing money is to increase taxes. That is going to kill disposable income. It's a shock to consumer disposable income that this 70% consumption society has never experienced before. And corporate taxes will be passed on because right now they're being sold to us as primarily corporate taxes, or the taxes of the rich. It's like the camel putting his nose under the tent. He's soon inside the tent. It'll be everybody's impact. And as corporate taxes will be passed on to consumers as price increases or in getting less for more. The wealthy will have less to reinvest, which means lower asset appreciation for IRAs, 401k plans, as well as new business ventures. All this will add up to significantly reduce disposable income and hence reduce consumption. And and I'm only touching on the American Job Plan here, which is $2.25 trillion. The American Family Plan, which is $1.5 trillion. So $4 trillion. The total wealth available to take away from the wealthy doesn't put a dent in three. We don't understand what $4 trillion means, right, Charles? The numbers don't add up, which is going to mean taxes at some levels, which are going to crimp this disposable income, which is a shock to the global supply chain. And I got a list here of some of the corporate taxes and the fallouts from them. Some of the big tech $100 billion foreign profits are hoarding offshore. What's going to happen there? This is what's happening with the capital gains tax, taking the upper end of doubling it to 43.4%. The Yellen's global minimal tax for making sure that any corporations around the world are going to be taxed at minimal kinds of rates. It's almost like a universal tax rate for corporations. Then it's going to lead to, and I don't mean to go on here, Charles, but then it's going to lead to the second big pillar. Crushing disposable income because of taxation and these other programs, lost jobs, which we talked about in the tsunami, is one element. But the other element is when you print this amount of money, and as you said earlier, eventually the dollar has to fall, has to start coming down. I have a belief that the dollar is seriously overvalued because of the buying of our treasuries as a strategic plan by foreigners, which has worked beautifully in their mercantile strategy. But this demand is going to subsequently result in a falling dollar. This falling dollar makes goods more expensive as imports to everything we consume is made offshore. So suddenly your dollar can't buy these inflated or imported products because of a falling dollar. So it's going to be another consumer inflation shock, as I'm laying out here. And our thesis paper that we laid out, De-dollarization in 2019, outlined why the dollar would fall, irrelevant of COVID. And that we did this before COVID. And this is another shock to that understanding. These two pillars have frankly ordained that the big wave shown here that we called the tsunami wave, which is massive and compared to what is shown in blue writing, which we called the deflationary tsunami, is coming sometime in this decade. Any comments on this, Charles? Sorry, I didn't mean to go on, but I'm just summarizing this.
No, I'm glad you covered the core topics here, and I just want to go back to your slide on the unintended killing of the golden goose. And your reference to oil and gas and fossil fuels is that we have to remember that the rise of the great middle class consumer that we're talking about here over the last 75 years, it was originally based on U.S. energy independence and actually exporting. I mean, the U.S. was the Saudi Arabia of the world for the first half of the 20th century, and that wages and financialization both occurred when the U.S. started to have to import oil, right, in the 70s. And so um, energy is a core element, not just of the economy in terms of like the cost structure, but it's like the amount of energy each person has that they can afford to use to, fuel their consumption. That's important. And so if you take away U.S. energy supply in any way, shape, or form, then you're going to have um, less uh, resources to consume, and that's just the way it works. And so if the U.S. can substitute alternative energy, 1 unit for 1 unit, as it no longer exploits fossil fuels, well, that will be fine. But that's a hat trick that has yet to play out. We may not be able to replace 1 unit of fossil fuels with a unit of alternative energy um, fast enough to get to everybody's golden point of a carbon-free, economy. So I just wanted to re-emphasize that's a key element here, the energy policy, and it's worth exploring further. But the other thing I want to talk about too is that governments always do the same thing. And this is where we were talking about that in past programs, which is when they start overspending, then they've got to raise taxes, and then they have to devalue their currency. There really is no other way out. And so some of these tax increases that the Biden administration is proposing close gaping loopholes, and we can all support that. But the bottom line is, if corporate profits fall, that's also going to have an effect on consumption, because it's going to trigger the reverse wealth effect that we covered in previous programs. In other words, when corporations had a free run over the last 20 years to, evade taxes, pay very few taxes, and pile up, tens of billions of dollars overseas, all of that, that's part of why the markets have skyrocketed. The stocks, right, is the corporate profits have skyrocketed from less than $1 trillion to $2.5 trillion a year. Well, these higher corporate taxes are going to impact that, and then you're going to get the reverse wealth effect, which is a form of a depressing element in consumption. So all of which brings us to the what you've mentioned before, Gordon, which is the stock market is extremely large, but the bond market, it's even larger. And then the ultimate arbiter of value in an economy is the currency.
Precisely. People really forget that. The stock market's nothing more than the tail on the dog. And it starts with the currency. Trades $5 trillion a day. And any shift in the currency has profound impacts. I think there's over $600 trillion in currency and interest swaps alone, as registered by the Bank of International Settlement. So just to put it into proper perspective. And then, of course, there's the 800-pound gorilla in the bond market, or more properly said, the credit market, which keeps this whole thing afloat. And when you start to shake that, small moves, small vibrations in it has profound impact on the stock market. And corporations if they're taxed more, they're going to cut back. They're one way or the other. They're going to give you, as I said earlier, give you less for more, or they're going to charge you more. They're not going to absorb it. Not all of it. CEOs get fired when profits fall, and they don't have a plan to fix the profit line. But it all stems back, Charles. This happens generation after generation, country after country. It's the cycle that we go through, and there are various cycles that show the sequence. And the one I have up here is the fiat currency failure. And it's a preordained cycle that we go through once we get off sound money, once we get off debasing currencies, living beyond our means. It's only a matter of time before we follow certain sequences, and you're locked into it. And that's what's happened here, and that's why we're locked in now with with COVID and our reaction to COVID, based on where we're at when it did happen, but our reaction to it through taxation, crippling of the golden goose and disposable income, a subsequent currency devaluation to lower levels, locks us into this. Now, on the other side of this, because it'll force changes, because the simple truth of the matter is we have global imbalances and massive inequality in the world today. And there's ways of fixing it. Some are going to be good. Some are going to be poorly thought out. They're going to be difficult, but they will be fixed in this decade. I'm very, very hopeful of that. And on the other side, the world will be better. We'll be better off for it, because we never designed globalization. It just happened. And we're going to test it, and it's going to fail. And we're going to have to correct it, which we will do, and we'll be better off. So the key now is to be prepared for this decade's going to be about, so that you're better prepared for the next decade. And you can build a solid life on it. So get ready for this, because it's going to happen, whether you want it or not. Whether you believe myself or you believe Charles, it's going to happen. It's now preordained. It's just basic arithmetic. Charles, any concluding comments you'd like to make?
Yeah, I just wanted to add that this dynamic that we're describing today about the U.S. Ending its overconsumption one way or the other is going to have global implications, because it's not just a U.S. Dynamic. The U.S. has been the dumping ground for the entire world economy for, goods, right? And so if we're not buying everybody else's trillions of dollars worth of surplus production, well, then their economies are going to go into a tailspin too. So it is a global phenomenon that we're describing.
Last concluding comment I'd make, Charles, for our listeners. We've had nearly 10 years of things called quantitative easing, an untested monetary macroprudential policy in concert with something called financial repression. But the whole concept really between quantitative easing was to keep the economies going by bringing demand forward. And let's assume that they were very successful, because we've had a booming 10 years. We need to appreciate that when you bring demand forward, that creates a big hole on the other side of demand. And we didn't even mention it today. So just think of the shock that this will bring to an already and crippling demand to an already short demand. And that's what the whole global run rate is based on. And that demand is going to weaken. And it doesn't take very many percentage points in a highly leveraged, historic level of leverage to bring the cards down pretty quickly. Doesn't mean the world's going to end. Just means a correction will be forced into the system. Charles, where can our listeners read more about your writings and some of the things you put out?
Yeah, please visit me at of2minds.com. Free samples of all my books.
Talk to you next month.
Thank you very much, Gordon.
Thank you. Bye-bye.